Welcome back to my channel, Ultimate Crypto Bureau. Today we are going to cover a very important topic within crypto world. This topic is about how to dollar cost average to increase your coin holdings at a better price than your previous buys. Everybody wants to know how to do it. Experienced crypto investors often use this strategy during the bear market so that they can grow their coin portfolios with average price, which is better than their previous buys. Before we get into this video, make sure to hit like and subscribe to my channel and click notification buttons so that you do not miss the best opportunities we bring you in cryptos. Here we go, guys. In this video, we will be using Solana as an example coin for our dollar cost averaging. So, say you have, $1,000 to invest, and you only want to invest in one cryptocurrency, which you believe that is, the most important cryptocurrency, which you believe that, this cryptocurrency will do, 20x, 50x, 100x, whatever, it's your target, right? So how would I go about investing one coin into one coin only, and how would I go about it? As we know, crypto markets are very volatile. So what you should do is as follows. So for example, we are going to buy Solana at today's cost price. Say we're gonna round up the our investments. So say we bought Solana at around, we want to buy Solana for about $200, right? So we're going to buy at around, say, for example, we bought at current price. So we're going to have, 8.5 Solanas, we bought at current price, right? So what happens is, as we know, price fluctuates quite a lot within the crypto world. When the news comes out, or when there is a bear market, or this strategy is especially used during the bear market, the dollar cost averaging I'm talking about. So how would you go about dollar cost averaging? You have £1,000 to invest. You have actually bought worth of $200 of Solana, right? At a current average price of 23.60. Now, say, for example, Solana's price has, gone down 25% from the current price, right? So how are you going to go about this? Basically, that's the most important part, right? So say Solana dropped to around, $17.50. So what I would do is I would go again and buy Solana at an average cost of, say, for example, if the price has gone to, $18, right? So I would spend another $200 to buy Solana. So I will be probably buying 11.0.1, I guess. Yep. 11.1 Solanas at $18, that my buying price. Yeah. So now the average price becomes, as this is showing you the current price, right? So now your average price, as you guys can see, that if you do the average of both prices, you can clearly see that, your average has been reduced. So if you look at 23.60, right? So we can have a calculator in front of us, and we can do that, right? So you can do 23.60, right? That was your first coins that you bought, plus times that by we'll do times that by the initial value that we actually bought, right? Which was around, if you look at the transactions, right? So this will give us a very nice and clear picture of what we actually did, right? So as you guys can see, we bought 23.6 times that by 8.5 equals $200, right? Plus we spent another $200, right? So we ended up spending another $200. So total we spent is $400 so far. And we have around 19.6, so 11.1 plus 8.5. So we have divide that by 19.6 Solanas. That's the total quantity that we currently own, and we have spent $400, right? So our average price currently becomes $20.40, right? That's the average cost, net cost it's showing you here, right? So we spend 19.6, $400. That's the average cost price. Now, remember we started with 23.59. Then we got Solana from $18, right? But the way I do my dollar cost averaging is that if a particular asset drops 25% from its average, from the price that I bought, then I do a dollar cost averaging. I don't do dollar cost averaging like what other guys are doing when like they do weekly dollar cost averaging or monthly dollar cost averaging without even thinking where the price is. The most important thing is the price. What did you previously buy? There's no point buying a coin when, for example, if you bought at 23.59 and if Solana jumps to $35, there's no point buying at $35 because what are you doing is you are actually increasing your average price rather than decreasing your average price. Idea of dollar cost averaging is to decrease the average price so that you can make maximum profits when the price eventually shoots up and gives you those 5x's, 10x's, 20x's, 30x's, whatever, right? So now, for example, from $18, if that drops another 25%, which will bring us around, $13 for us. So what I will do is I will go ahead, do $13, right? I will spend another $200. So that will become roughly around 16, maybe 15, 15.4 Solanas. So I'll add that on here. And as you guys can see, now our average cost has gone down to 17.16, right? You have now got 35 Solanas. You have spent $600. Your average price that you started with 23.59. Now it has gone to 17.16. So if the price then jumps back up to close to our first buy entry, then you are already in profit of 37%, $225 in profits. So as we know, Solana did come all the way down to around $10. So what I would then do again is, for example, if he comes down even further from $13 and he came down to around 10.5, right? So that's another 25% drop. So this is what then I will do is I will go ahead and buy another 200 worth of Solanas. So I would do then the average price, say for example, if the price dropped to 10.50, or you entered a buy limit order at 10.50, you want to spend $200 on Solana, then what will happen is you will end up buying around 19 Solanas, right? So now if we submit that, there you go, guys. Your average price has now come back down from $17 to something to $14.82. You have got 54 Solanas. You have spent $800 for now. And if the price has now gone back up from $10.50, it come all the way down to this current price, right, of 23.6, then you've already made nearly 60% profit on your initial investment. And we haven't even invested, we haven't even invested $1,000 yet. We've only invested $800, right? So this is a best strategy during the bear market. You must choose a coin which you believe will do extremely well in the upcoming bull market. Remember, guys, we have cycles, and every asset class has got cycles. You've got the down cycle, you've got the up cycle. We call it the bear market, and then we get the bull market, right? So what happens is, during the bear market, most of the people start selling their coins because they either get too scared or they think that, oh, bear markets is not worth holding the coins. We're just going to dump it, and then we're going to come back during the bull market. That's a wrong strategy to use, guys. That's a very, very wrong strategy to use. Yes, if you would have sold in the bull market at a peak of the bull market when Solana's price was $250, you sold all your Solana and you're realizing that, okay, price is actually coming down, and I will only buy it when it comes down to 80% down from its all-time high, or 85% down from an all-time high, then fair enough. Then if you're willing to wait for another 16 to 18 months, so be it. That's a very good strategy as well. However, if you want to average down your price of your entry or any coin, really, to be honest, whether it's a Bitcoin, whether it's an Ethereum, whether it's Solana, whether it's Cardano, whether it's Polkadot, whether it's Cosmos, whether it's Shiba Inu, or any other coin, guys, this is the best way of doing it. Now I will tell you how people get it wrong, and how other people are teaching them to do it wrong, incorrectly. So let's say, for example, right, I am now going to remove all of these ones, okay, and I'm going to show you what most people in cryptos, if you're a newbie, or if even some experienced people have seen them doing dollar cost averaging absolutely incorrectly, basically. Now, for example, so I'm going to do the same thing. I'm going to invest like $1,000 in Solana. So I'm going to use around 8.9 or 8.1, maybe 5, right? Okay. So 8.5 Solanas are bought today, right? So say after a month, the Solana's price has gone up to around $30. Or let's say it's increased by 25%, right, from the current price. So we round this up to 24. 24, that is 2.8 plus 1.2. That's around 4, right? So that's going to be 28. So for example, recently we have seen Solana hitting $29. So we're going to end up buying around, 7.1, maybe 7.15. Yeah. So now we bought again. We're still doing dollar cost averaging because we believe Solana will just keep going up, right? And then we bought 7.5. Now you see the difference, what's going to happen to your price. You've already gone minus here. You have increased your holdings. However, your price is now gone to 25.62. So you increased your average cost, and you're already minus right now, right? Then the price has gone up again a little bit. And from $28, we'll do another 25% on this one. So say around $34, right? So then we went ahead and bought Solana again at $34, right? And you are saying, right, I'm going to now buy worth $34. So I'm going to go for 5.9 Solana at $34. So now see what happens, right? Your holdings has gone up, right? Your total cost is 0.601, your average price has actually increased and you are now minus $92, right? So you could ask me, Seth, hold on a second. We know, that price can go up and down. Fair enough, right? So you decided to say, right, okay, now the price has gone down to $30 from $34, and you decided to buy for another 200 worth of Solana, right? So you're going to do 6.8, and you're going to do around $30, 6.7. There you go. Now you spend $800. Your average cost is around 28.41, right? And you're still minus you're still minus 135.21. Now you're thinking, actually, I have done dollar cost averaging. I started with $23, then it went to $28, then it went to $38, and now it's gone to $30. And my average cost has gone 28.41. I'm losing money right now. I'm nearly 17% down on what I've spent so far in one coin. Now, if Solana now goes down to below your average, for example, Solana's price now goes down. So remember 28.25, right? That's your holding. So if Solana's price goes down to say 20, so let's do that. So we will do 28.5, the 28.25 times by 20, 565. So now your average cost has been 28.41. You spent $800, on Solana by dollar cost averaging, and now the price of Solana has dropped to $20. So now you are predominantly, if I look at it, divide that by 802 equals that, right? You are now already 30% down on your portfolio. So if I do that -1, you are now 29, nearly 30% down on your portfolio, guys, of just one coin, right? And you may say, right, but it's come down to $20. We can invest another $200. Fair enough. We could easily do that as well, right? Because the price always comes up and goes down, comes up and goes down. It always does that. It never stays stationary. However, one thing you should always remember, folks, is that you only do dollar cost averaging when the price is going down, further down than your initial price. Then your average net cost will be coming down along with, the price itself. So even if it comes down to 90% down, even if it comes down to 95% down, your average cost has been continuously reduced, right? That is the best strategy. Then when it starts going up, so for example, you've done the dollar cost averaging, that's your average price. And now suddenly Solana has shot up to around, $80 to $100. Then you can say, now I have 3x or 4x or 5x, right? But the whole idea is you only do dollar cost averaging when the price of the coin is actually going down. I would do dollar cost averaging 25% at 25% drop from my initial entries. And if it drops another 25% from the second buy entry that I have, then I would buy more and reduce the average cost price of the coin. this is the best way of doing dollar cost averaging. There you go, guys. This is how I would do dollar cost averaging into any crypto coins. Please remember to research, and everything discussed in this video, guys, is only for educational purposes only. Until next time, have a fantastic day, and I see you in the next video.